Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by foundersuite.com. Today I have Jessica, Rolph, and Rod Morris of Lovevery coming to us from Boise, Idaho. How's your day going, guys?
Doing great. Yeah, lots to do. Keeping busy, but great to make time to talk to you.
How'd you end up in Boise? Why are you guys in Boise?
Good question. So 10 years ago, my husband had a job opportunity here. We've never lived here before. And so we took the bet and moved here, and I built my part of Happy Family, my first company here in Boise, and scaled that until we sold the company 5 years ago. And then when we...
Yeah, so I know Jessica through my wife, actually. They grew up together, and our families would vacation together all the time. And that led to ultimately Jessica and me starting Lovevery together. And when we were thinking about where we would build a company, we kept finding more and more reasons to stay in Boise. It's a great place to build a business.
I want to come back to that. I want to talk about Boise and the Western startup scene and stuff, but let's just get into what you guys do. What is Lovevery?
Yeah, so Lovevery is a stage-based learning program. So 80% of the human brain is developed by age 3. And parents are often receiving toys and getting some information maybe from their pediatrician, but no one is really holding them through that important early journey. So we are there to partner with parents to be a support system to help them make the most of these early years. So about half of who we become is based on our genetics, and the other half is based on our environment. And so we help parents create a really intentional environment through toys, tools, information that is delivered in stages. So as the child grows, you get another box by a subscription.
Okay.
And then you know exactly what you need to do and how to play with your baby at that stage and how to make the most of their learning.
And so it's one box per what? Per 6 months, per year, per some other time frame?
Yeah, great question. So it's every other month for the first year. And then for the second year, it's every 3 months.
Interesting. And give some examples of like what's in, the first few boxes.
So babies, and when they're first born, see best in high contrast. So black and white images. And actually science shows that if you show a child progressively complex images, it will help strengthen their brain-eye connection, which really builds that neural association that's priming them for understanding the world. Babies first take in the world through their eyes. And so we have a set of black and white cards that starts out simple and then gets more complex. We have a black and white mobile that then flips to color for when the baby can see color around 4 or 5 months. And so it's just a kit that has a bunch of information and ways to engage with your child, activity ideas, but then also in that first kit, it's very heavily focused on high contrast, for example.
Sure, makes sense.
Yeah. And then a later box, for example, might be around 9-10 months. The baby is ready to start coordinating their body and their eyes. They have the hand-eye coordination to both grasp and release. And so we have what's called a ball drop box. And this is based on a Montessori principle. It's a very classic Montessori classroom item. And we've really brought that to the home, and it helps babies love to figure out how to put the ball in the box. It then disappears for a second and then reappears. And so it works cognitive learning on object permanence, like, wow, that's gone? Is it gone forever, or will it reappear? And so babies start to learn the principle of object permanence, and they also then understand how to coordinate their body to release the ball into the hole, drop it in, and then find it again. So those are just 2 examples of kind of the products that are right for each stage of development.
Sounds fun. Did you invent these different toys, or are these things that were out there on the market that you've sort of assembled into a subscription?
Yeah, we develop everything ourselves. And so we take inspiration from neuroscience, from experts in math and early learning, from the OT community. So there's a lot of professionals that are working on speech and early kind of gross motor skills. And then, of course, Montessori. And then what we find a lot of inspiration from is just the inventiveness of parents. So oftentimes parents will create DIY toys, will then go through a process of testing items, and we develop them ourselves, and then test them again to make sure that they are the right age and stage. And then we assemble them into these kits.
Interesting. It reminds me, it's funny. I'm thinking of a few different things. Like I remember when baby Einstein was a thing, right? People would pay anything thinking it would boost their kids' intelligence. This probably isn't going to be a phrasing you'd like, but I'm almost, it's like baby Einstein meets Melissa and Doug toys in a subscription wrapper, sort of.
Yeah, I think that parents are really hungry for a modern alternative. And I think that there have been some great products in the past. I think that parents right now are concerned about digital overload. So exposing their children to too many flashing lights, too many digital stimulation can actually be harmful, and almost is like empty calories for a baby's brain. Just like you have empty calories for baby's body, you can also have empty calories for baby's brain. And so the flashing light toys with a great brand, I mean, Baby Einstein is such a great brand name. It's the perfect name. But I think that parents have now found that doesn't really totally deliver and feel intuitively right. And then Melissa and Doug is a great company. I think parents are looking for something a little bit more modern in terms of a solution for their development. Some parents are hungry for a company to really hold their children through that development process.
Totally makes sense. Yeah. My kids are now 9 and 6, so they're beyond it. But like, what age group do you guys go up through? So infant to what?
Right now, we have our subscription learning program goes through 24 months, but we launched a block set recently that is like no other block set on the market. It's truly modernizing blocks, which are unfortunately collecting dust in parents' homes. They've been widely replaced by Magna-Tiles and Legos, which I'm sure your house is filled with. Blocks are an early learning essential because children learn how to balance, and they learn structure in a way that they can't learn if the pieces just pop together. And so we launched a block set that really brings blocks back to modern homes, and that ages up to 6 or 7 years old.
Oh, interesting. I spent a lot of time with Magna-Tiles, I have to say, and they're fun, actually.
They're super fun.
Yeah, enjoyed them. Cool, interesting stuff. Yeah, I think you're tapping a great vein, right? Like parents will spend anything on their kids and giving them a leg up. My wife, one of her little stories, she worked at a baby store, and she said, you could upsell. The upselling at a baby store, for example, is off the charts, right? You just say, this crib is safer than this crib. This $500 crib is safer than the $300 crib. And parents just go for it, right? Like it's a, I think it's one of those categories that people will spend whatever it takes to kind of satisfy their needs. So good.
Babies and pets.
Kudos for you.
Yeah, we always say babies and pets. We want it. Those are great investment categories. So
what's the backstory? How you guys had previous companies? How did you end up at this company? Maybe touch on those previous companies and how you ended up with this idea.
Sure. So I've known Jessica for quite a while. I came up in startups, but it was more technology startups. So the last one was a company called Opower, which was helping people save energy. I ran half that business and helped take it public. And I was on the management team. I wasn't a founder. And I'd known Jessica for a long time, knew she was a great founder. And when our families were vacationing together, she told me about this idea that she had, and it instantly sounded like an amazing way to make a difference for parents. And so when she started talking about it, I just instantly knew I wanted to kind of help her build it. Yeah.
And my background is before co-founding this company with Rod, I was the founding partner and COO of a company called Happy Family, and started that company in 2006. Mm-hmm. And when we first started the company, only 3% of all baby food consumed was organic. And now over 36% of all baby food is organic, and Happy Family is the #1 brand. We got the company to 63 million in sales and sold it for hundreds of millions to Group Danone. And it was a great success. And I think through that journey, I really felt so confident about what I was feeding my children, right? So I had, gone so deep in infant nutrition, and my little guy's one of his first words was sardines. I mean, they had the, such an incredible diet. And I found myself wondering what is happening with his developing brain. And I knew that there was so much that was going on for his brain, but I didn't know how to help. And so I had remembered having this moment with this like plastic toy where he was pulling himself up and pushing one button, and all of a sudden, the toy, it's like flashing lights are going off and a purple cow pops out and music starts playing. And I just was like, what is this? How is this helping him? I knew that 80% of the brain was developed by age 3, but I didn't know how to help. And so I discovered a doctoral thesis written on infant brain development and started thinking, what if we created an early learning program that would help parents feel confident that they were giving their children the best throughout early life. And so I was asking Rod, he's always been a mentor to me in business, and asked him, like, what do you think of this idea? And can we hash this out? It involves a lot of kind of changing behavior, because we have been buying toys sort of you've been getting kind of hand-me-down toys, or you buy a toy at the store that you were talking about that your wife would work at, or toys kind of come into our lives. And it's asking parents to take a step back and be more intentional about their child's learning and think deeper about this important stage of life. And so Rod's last company had studied consumer behavior and how do you change behavior? How do you change mindsets with Opower and help them think more deeply about energy? And so it's been this perfect match. It was so thrilled when he said that he was willing to partner with me to create Lovevery. It's been a really great partnership.
Yeah.
Cool. Just a little bit more about the business. So how much is the subscription? And do you guys, when a child ages out of a certain toy, do you take it back, or is there any sort of like recycling program involved, or not?
Sure. So the baby kits that come every other month, like Jessica said, those are $80 a kit, or $40 a month, basically. And the toddler kits, so after a child turns 1, those come every 3 months. They're $120 list price. So again, $40 a month. And parents keep the toys. I think we're working on different, longer term solutions for different ways of using the products. But right now, it seems like parents want to keep the toys after they buy them. So we're happy that they love them.
Yeah, and I didn't mean to throw it out there, but see, when I think of a subscription, like, again, my wife has all these subscriptions to rent the runway and, clothes that she's using for a period of time. And then, of course, sending back. I don't know if that's something you thought of, or maybe it doesn't fit. If the parents want to keep the toys, parents want to keep the toys. That makes sense.
Yeah, we've thought about it because we are really passionate about sustainability and the environment. I co-founded and created a climate collaborative for my last industry around how do we work together as an industry to address climate change. We're offsetting. Rod's last company was really focused on saving energy and helping people think more deeply about energy use. So we have a lot of sustainability initiatives within our company. So our products are made with sustainably forested wood. All the fabric is organic. We also support spare parts. We support the life of the product. So if you lose a piece, we'll send you just that one piece that you need to replace to make the product work again, instead of not supporting the product. You'd be amazed at how many toy companies will not just ship you the one piece you're missing. And so with that, we've also done some testing, and we thought that parents would want to return the products to us. We learned that parents actually want to save it for their next baby. Oftentimes they're on their first and they might want a second or a third baby. And they love to gift it to friends and relatives and box it back up and have it be that special hand-me-down moment. Or they want to give it to the local shelter, the local church. But these products are not ending up in the landfill. They're not ending up as waste because they're so high quality and so highly valued. I think the shipping back was actually too much of a burden. So parents didn't like the process of having to pack everything up again and put it in the mail and ship it back to us. And then, but we're still exploring possibilities there.
Yeah, great. Okay, great. Let's talk about raising capital. How much you guys raised over how many rounds?
So we've raised between a seed round, A round, and B round, and bridge in the mix there. We've raised $32 million.
Cool. Congrats. It's a ton. Let's take it a little chronologically. So when you had the idea, you came to Rod, let's do this. How did you guys get this off the ground? Did you use your own money? Did you bootstrap it? Did you go straight to angels?
Yeah, I mean, taking us a step back with Happy Family, it was all friends and family and individuals who invested in Happy Family, and it was a super hard road to get folks to invest. Our seed round took us 9 months to raise. We were raising $550,000, and we can go into details of that story. So because we had both been successful in our last ventures, we were able to capitalize the company with $300,000 in seed capital. And then we went into our quote unquote seed round. And I will say one thing about raising for the second time. It's easier, but it's not a cakewalk. And I will tell you, the hardest part is not actually the getting people to commit, because it actually truly was easier. It's actually getting up your own momentum and your own emotional gumption to say, I believe I believed in this. I can convince other people to believe in this. I almost felt like, I don't know if you felt like this, Rod, but I almost felt like I had more to lose the second time because I had been successful. When I would see doubt in someone's eye, who had maybe invested in Happy Family and who was not quite getting the vision that we had for Lovevery, because again, we had a slideshow. We had like some slides. We didn't have any product to show for ourselves. We had a vision, but no branding. We didn't even have a product name at the time. And it was vulnerable. And so it's so interesting to think that you can sell a company, have it out of the ballpark of success. Rod could brought his last company to over $1 billion in value. And here we are, trying to scrape together some capital in our seed round. And it was emotional.
I think that's true. Like I can remember like one investor in particular who I had worked with at the last business. So very familiar with me. And I think that the answer when pitching this investor was like, no, 2 or 3 times, but eventually got this investor in after about 18 months, and they've subsequently invested in every single round we've done. So I would say, yeah, I mean, I think it's not an easy start, but at the same time, it's way easier because of the track record. I think it's also easier because the track record and past success gives you confidence that you can kind of stick with it and be resilient and not take no for an answer and just keep going. Yeah.
But it is vulnerable. There is something like very vulnerable about raising capital, and it, you have to present confidence, but you also, there's the emotional side of it that is, I think, surprising for other people to hear, that people with Rod's and my background would feel that way. But, and with the success that we had in the raises, they all, on the outside, they came easily, but in the inside, to get to that place where you have momentum in the raise, is hard.
Yeah. So let's talk about that a little bit. So, I mean, maybe even take through, so you put in a little money yourselves, you get some slides going, you get this vision crystallized. And then how did you kind of identify investors? Like when I see this from the outside, it doesn't look like a typical venture deal. When you layer on the subscription model, now it starts to kind of look like a venture deal a little bit more. But like, how did you identify folks that would play in this space, which is a little bit outside the typical, Silicon Valley story?
Yeah, it's anywhere and everywhere. I would say, especially for Happy Family, when we were raising our first round. I mean, I would go to a wedding. I'd be pitching people. I'd be asking people if their parents wanted to invest. There were people that I thought would be our early investors. You always have that short list of people where you're like, these are my high net worth friends, right? Yeah. Or these are the people that I know that are connected to high net worth people. And I do feel fortunate through the alumni groups, through, I know that there's privilege that comes with that statement, but everybody has somebody who they think might be able to give them that first dollar. And it's so surprising because oftentimes those are the people that say no. And that's heartbreaking in the beginning. But then it's just this, who knows somebody else who's willing to connect you. And it's just this humble hustle that you do to go so deep. You've got to go layers upon layers into your network.
Yeah. I mean, I would say early on, like you're getting people who are betting on you, right? I mean, they have to like the idea, but even more important than that, like really, really early, it's a high level view of the mission and then their belief in you to deliver on it. And fundraising is about relationships, and you don't know who's going to say yes or no. So you have to manage all of those relationships, and you have to ask a lot of people. The thing that's fortunate is the classes in which people are investing now, the different kinds of companies people are investing in now. I think people are more open-minded than ever before, and I think deals that would have been considered, that's probably not a venture deal. That's changed as people have seen how these new businesses can take shape and be very attractive if they've got the right founders, if they've got the right vision.
I mean, who would have thought that organic baby food would have returned a 20x to our seed investors?
Yeah, no, that's great. That's amazing. Did you ever think about either, I guess you have physical product and inventory, so that costs money. I was going to say, did you ever think about just bootstrapping it or even crowdfunding it? Given what you're doing, it seems like this would be a natural for, 500,000 parents to want to crowdfund something like this. Or did you, always know it was VC?
The crowdfunding, I would say, we wanted to create a brand that people really trusted. And we, they're Kickstarter, and we evaluated some of the different platforms. Those are great platforms and they're super fun, but because there's such variety on those platforms, you don't know what you're going to get. And we're creating an early learning program based on neuroscience that has to be of the highest quality products that are so ultra safe for your baby. And so we wanted to create, we felt like we needed to create a brand that elevated and showed that there was capital behind our brand to be able to support the necessary, safety measures and to support the quality and to support the advisory board. So we needed to come out with a bang and in a big way to generate that trust. I think, I don't know if you have anything to add.
I think what I would add is we had a really big vision for building like a substantial subscription business. And there are lead times with inventory, like you brought up. So if we wanted to move fast, if we wanted to first launch with one product in market, but then very, very quickly be in motion to put our subscription out there on the market, we needed capital to support that. And it needed to be capital we could depend on. Now, we didn't start off going with institutional money. The amount of institutional money that's in the business has grown over time as we've hit different proof points. But it started off as not crowdfunded, but funded by a lot of believers who are angels who could help us kind of have the capital to support a longer term, bigger vision, and then acting on that vision quickly.
Yeah. And a lot of people ask me in particular, why aren't you self-funding this company? Why didn't you self-fund this to, the first, 10 million in capital that the company needs? Or why didn't you, put that money, to work? And I think that it was a hard question. I think that, definitely put in some seed money, definitely put in my life, passion, and energy. I think that there is something, that happens when you go out to the market to raise capital. And I think there's a self-referencing that can happen if you invest in your own ideas and you're putting your own money into your own ideas. And then you have to think, there's nobody telling you you're not great, right? And there's no way to test your hypotheses. There's no community of people that are behind you when you launch your company that are saying, we are behind this company. We want to help spread the word. And so I think ultimately, even though there's more dilution, I think Rod and I feel good about our decision at this point. It's also really stressful, and to have your own capital, all of your, net worth, half of your net worth, quarter of your net worth behind, invested in your company can add a level of stress in your family that is necessary when you're getting started. So with Happy Family, all credits maxed out, asking for, we had $10,000 in our savings account. And I remember I needed $10,000 to buy for Puffs, literally for the Puff cereal, because we couldn't pay for the shipment. And so I'm just calling my husband one day and I'm just we'll get it back in 4 more days. So there's that kind of the first company, but then there's a second company when you've been successful. I think there is a question of why aren't you funding it yourself? And I think it's a very personal question, but I think for us, there has been power in having this community of investors behind us.
I guess I'd just add, every time we fundraise, we get much smarter about how we run this business. Every single time, I'd say we've leveled up the quality of the business that we're running because of the input that we've gotten, not just from the people who choose to raise choose to participate in the raise, but also from pretty much every investor we talk to, the ones who say no as much as the ones who say yes.
Yeah, let's go forward a little bit to, I guess, well, we can go A and B, or if you want to pick them apart, that's fine. But you've got some interesting names on there like Google Ventures and Maveron and Chan Zuckerberg Initiative. Maybe talk about putting that list of names together. How'd you identify these guys? How'd you get in front of them? And like maybe in a separate topic, I'd like to hear about what Chan Zuckerberg is like as an investor. Big question there.
I think like all of our investors are great. I hesitate to sort of, kind of characterize each one individually or anything like that, because I think they all bring something to the table. The thing I would say about this is with the investors you named, plus a lot of other, great ones that were in, kind of earlier, Reach Capital, Founder Collective, Collaborative Fund, a number of others, Yes VC. I think that all of those folks who participated were in a longer list that included folks who either wanted to participate and kind of we chose these instead, or who like we couldn't find common ground. These were all relationships that we cultivated over a long time. So even when we were doing seed raise, we were starting to build these relationships, and that made it more possible to kind of like have a warm conversation during the A. And then in the B, I think the one common thread I'd say across all of these companies that participate in our fundraise is that they are really mission-driven firms. I think pretty much every single one really cares about people and making people's lives better. And so that's something that kind of rose to the top as a theme as we worked with all of them. I don't know, what would you say?
Rod would drive me nuts. Right. So I was like, we can just cobble together this money. There are people, there are humans, there are people that will, we had somebody who rode his bike up to my house after we sold Happy Family and just gave me the biggest hug and said, thank you for sending my kids to college. You just sent both of my kids to college with this investment. And he didn't invest that much. And we sent his kids to college. It was so exciting. It was so meaningful to have these people behind us. And so in approaching Lovevery, I think we really leaned in to our networks, and we really wanted to give the Happy Family investors another opportunity, the Opower investors an opportunity. And so what we did is we actually filled out a lot of the A round. So not only did we do a seed from individuals, but we did an A round with vast majority of individuals. And so
some institutionals started to participate.
They started to participate at small amounts. And so Rod then is like, Jess, like you got to take a break. We got to take a break from the product. And we got to do this like venture tour. And I was so intimidated by the concept of venture. I had, felt so good about this kind of transparency, this human connection. I didn't know what it was going to be like raising from venture. And so we had to take time out of the business. And I remember being on like the 12th meeting, and we're lugging a suitcase around San Francisco. And, there's this, it's like very humbling because people are, I'm like, we got to bring our product. And so this is a giant Patagonia bag with like, prototypes. And I'm like, it's embarrassing, but it's also the way it needs to be done. And I was like, Rod, why are we doing this? I was so exhausted. And he was just like, trust me, it's worth it. And so we went to the B round, and it was so worth it because we had said what we were going to do. And we walked into the B and those early meetings, and we got second meetings and even third meetings because we did what we said we were going to do. So
performance-wise.
Yeah. We hit the revenue targets. They saw where we were, and being able to track
and product
momentum, and being able to even just be part of a story. Yep. It's like we had a story, and there was longevity to the story, and they got to know us in multiple contexts and built trust. Even if you don't hit your numbers perfectly, at least they know that there's a journey there. And so I think I really believe in that. I will say that in our B, it was harder to not have brought in venture in our A, our Series A, because
to a greater extent,
to a bigger amount, because they were in for smaller chunks. So the B, it became a harder risk return profile to sell to our B round investors because they hadn't gotten in the A and they didn't have that lower cost of capital. It actually put a bigger burden on the risk return profile in the B because they were coming in later. And so it had the company, because they didn't already have a meaningful stake and they were just re-upping their investment, it made it harder. I thought we were the smartest people on the planet because we were like, we can hustle individuals. We'll just hustle this whole round of the seed and the A. But it did end up being a little bit of a pause. It made it a little bit harder in the B. We ended up obviously coming out on top, but it is a numbers game. We met with probably 25 firms
I think
for the
more.
Series B.
I think even more. Yeah, maybe 30.
Yeah.
Yeah. So it's, I guess what I would say, like the way I would say that is like what you do in one round in terms of who you talk to and who participates, and then how you stay in touch with them after affects what you're going to do in the next round. So it's not like these are like isolated events that don't impact each other.
And I think that's an interesting topic. Let's drill on that a little bit more. I guess, what's the takeaway? What would you advise others to sort of do, right? If these rounds are sort of interconnected, does that mean you start talking to later stage investors earlier? Does that mean not doing so many individuals in the A? Like, what would the takeaway be, kind of?
I think like the takeaway I would have from all this is, like, I don't think anybody really enjoys, fundraising. If you're really like an operator, you want to run your business and build your business, right? And so like it's you have a bias to want to like go and spend time on your business as opposed to the funding that fuels your business. So I guess like my takeaway would be, no matter how early you think you should be talking to potential funding sources or how much time you should be spending talking to potential funding sources, you're probably underestimating how much time you should be dedicating, and you're probably not spending time early enough, with enough different people to just sort of make your odds as good as possible. And also, like I said, you get smarter in the process talking to these people, so it makes you a better operator anyway.
And I will say that there's an emotional piece to that. And I keep bringing that in, but I think that it's real. That you don't want to get in front of them. You're like, I'm not ready yet. I don't want to meet with Sequoia. I don't want to get in front of like the hottest female investor in Sequoia when I don't have my brand like the way I want it, and like the products aren't rolled out and I've got my prototype and it doesn't look good. And the deck, our performance is just okay. You got to push through. You got to get in front of that Sequoia investor. If you can get the meeting, take it and do your best. And I think that that's a lot of kind of the mentality of fundraising is kind of mind over emotion, and putting one foot in front of the other and forcing yourself to get out of your comfort zone and get in front of people, even when you feel like you're not necessarily putting your very best foot forward, if you're doing those earlier meetings. I think the second thing is I find a lot of people struggle in the seed. And I think that they actually want to go to venture in the seed, or they think that they are going to be able to pull in hot, funds even in their seed and their A. And I am all about we're all about low minimums. So I'm talking like at Happy Family, we took in $2,500 was our minimum. Mm-hmm. Not like 2,000, not like $200,000. I'm talking like $2,500 because somebody was like trying to decide between, getting a new stove and investing in our company. Right. Mm-hmm. And I'm like, just fine, get the new stove and just give us $2,500. It'll be fine. And so I think taking really low minimums is really important. I think not waiting to set the terms. So not waiting for a lead to set the terms, but set your own terms. Be reasonable in the seed. Do a lot of research on what's market, and err on the side of a little bit generous. I'm seeing, as an investor, I'm seeing a lot of deals right now where I'm like, there's no cap on the seed. And I'm like, how is this like, there's no cap on the seed? This is wild. But anyway, so put a cap, make it, something that's reasonable, and then hustle it. And I would say, and then kind of be willing to take those other meetings early.
Yeah, it's good. Did you guys, for your seed, did you do a note or safe priced round? What was your structure?
With a discount and a cap.
Mm-hmm. Note plus discount and cap's pretty straightforward.
And interest, yeah.
Interest, discount, cap.
Yeah.
Note.
We ended up hitting the cap, so.
Yeah.
Great. Explain that just for anyone not familiar. You hit the cap for your Series A, you mean? Or
yes. So the Series A valuation came in higher than where we had capped the note in the seed. So,
so
the investors,
the cap.
So the investors did well because they converted at a lower valuation than what the valuation was for the A.
Did you set the cap at a valuation you pretty confidently were going to hit? Did you sort of not artificially, but did you keep it a lower cap? This is one of these like.
I think we did the cap as aggressively as the market was telling us we could do it at the time that we did it.
And we did that because we were serial entrepreneurs, and we were out for the second time, and we felt like we could pull that off.
And when it got to the A round, I think the business was growing much faster than we had expected, and the valuation just came in like higher, than we had hoped, at the very beginning. So we ended up seeing the cap. Yeah.
I'm going to go back to something you mentioned a minute or two ago, just to drill into it a little bit more. This balancing act of getting out there and talking to investors well in advance of when you might raise. Maybe the question is how far in advance, and then balancing that with like, you're not very confident in what you've got, right? Like, how do you sort of, I guess maybe the question is, when do you comfortably start talking to investors? And we can use timeline, stage of business. Is it 3 months in advance? Is it 6 months in advance? And do you couch it like, hey, I'm not planning to pitch you, Mr. and Mrs. Series A or Series B folks, but how do you sort of frame it, right?
It really depends on the quality of your relationship with the person that you're pitching. If this is like a completely cold pitch, I think you want to be pretty dialed if you're coming in cold to somebody. I think on the other hand, if there's somebody who knows you, or like you had a very warm intro from somebody who knows them well and spoke highly, if it's an experienced investor, they're used to seeing things that aren't perfect, and they appreciate the opportunity to, like, if they're not quite ready yet, to see where you're at in 3 months. So I would say the more comfortable you are with the investor, the earlier you should start, and you kind of never stop talking to funding sources. It's just sort of like an ongoing thing at that point. And the other sort of angle on all of this is, if there's somebody, if there's somebody who's a really important potential investor because of the size of the check that they can write or some strategic value that they bring, that's also one where you probably want to be pretty dialed as well.
And I would say that you're never going to feel what is dialed. You're never going to feel dialed.
That's fair.
And so I think that it's really important to just put your best foot forward, but force yourself to have those earlier conversations. Because I think that no entrepreneur is going to feel dialed. I would say timing wise, we're looking at our Series C. We're like, 18 plus months out. Yeah. We're having meetings next week. So for a Series C, that feels about right. We start to have these meetings. We keep these things warm. We probably then will check in with them in another 6 months. So have a couple meetings between the B and the C. And with 6 months spaced out, I think in the, it might be like, 6 months after you raised your C before your A.
Totally.
Your seed, before your A.
Okay, so let me again. 6 months before. Just say that
before you. So if you raise your seed, let's say you hustle your seed and you figure it out, and you're like, you've got run room about like 12 to 15 months. So earlier than you think. 6 months after you raise your seed, Rod had us on the road again, in front, and it felt early. It felt early, and it felt like, what kind of news do we have to share? Is it really that different? But it is different. And it's we have made a ton of progress, and there are things to share. And I think that taking a lot of time to listen, pitch and listen, but really take the time to listen is important in those meetings. That's what Rod was getting to.
Well, that's what relates to feeling dialed too, right? Because I think you're right. You never feel 100% dialed, but you get feedback as you go to all these meetings, and you get better and better. Your pitch gets tighter. Your understanding of your own business gets better. So yeah, you're never perfect, but you're way stronger after 10 meetings than you are at the beginning of the first one.
Yeah, absolutely. Any tips for do you couch it or qualify it if you're starting 6 months in advance or even 18 months in advance? Do you kind of qualify it like, hey, our metrics are really Series B metrics, but let me start talking to you. Sort of, you know what I'm saying? Yeah,
I think what you had said earlier. Hey, I want to have a check-in. If you have an intro and you've gotten a no, we've gotten no's from people on the B that we're meeting with that could be still in the mix for a C. Sure. And so you're still confident, even though you got rejected. You're like, nope, I'm going to just put myself in front of you again. And I'm just going to say, hey, do you want to check in? Let me show you our progress. You try not to take it personally. So I think it's a check-in. It's not like a pitch, as you had said earlier. I think, Nathan, you had said like, hey, we want to check in and see, just want to tell you about how we're doing. And I think as you're getting further along the process, like, investors are curious. Really, a 30-minute meeting is not a big deal for them.
Do you do a newsletter or anything like that? Or is it all pretty face-to-face or, live?
So we write up a periodic update to our investors who are already invested in the business that we send out that's independent of board meetings, that's just informing kind of all investors how we're doing. And then if there's somebody who's not an investor yet, but we're getting ready to meet with them and we have the update, we might forward that to them just to give them a feeling for how we're doing. There are some investors who we've done that multiple times just so they can continue to follow the story. And then you make it less high pressure when you're meeting with them, right? Like, hey, I'm in San Francisco, next week. If you've got time, you want to just hear like a live update, we'd love to meet with you, kind of a thing. It just takes pressure off.
Yeah, that's good. You mentioned before the call, Rod, you kind of have a playbook, and you mentioned like generating competition on deals. Any nuggets or wisdom or tips to share about generating competition around a deal?
I think, a lot of this is from feedback that I got from successful founders around how to think about it. I think a lot of it just comes down to timing and talking to enough of the right people at the same time. So there are things that you need to do. One is like managing all of the investors you're talking to, like a sales pipeline kind of. So every fundraise, we've kept a spreadsheet tracker of like all the investors we're talking to, who our contacts are with them, what stage of conversations we're at with them, kind of very similar to a pipeline. And then once you kind of have enough folks who are in the same like late stage of the pipeline, say like due diligence stage, or even like right before they're about to move into due diligence stage, you want to lay out, kind of a target date by which you're trying to get to term sheets, so that you're not doing anything artificial, but you're creating some kind of a timing constraint that folks know that other players that they could be competing with are working against. And then, I think it's a fine line you're walking there, because you don't want to seem entitled. You don't want to seem, too salesy or too aggressive. What you want to do is make sure that you're just presenting the information. Like, hey, I've got something that I'm trying to do. I'm trying to raise this amount of money in this time. And so as you would expect, I'm talking to a lot of different folks. And right now, you're in this stage. I've got a few other people who are a little bit farther ahead than you. So if you're interested, you need to kind of move a little more quickly. And we're all working toward term sheets by around this timing. And so the more that you just sort of make it about a really logical process, and then the more that you guide people to a similar time window, and the more that internally you and your co-founder, anybody else internally who's supporting you, understand the different stages and how you're trying to work it, and your lawyers as well, the more effective you can be at doing that and not seem kind of like you're saying one thing and doing another.
What percent, let's just use a percent of, I like that almost trigger. Once you have a certain maybe percent or number of investors in diligence, maybe you sort of introduce this timeline. Any like heuristic around that? Would you say half of them in due diligence or what?
I don't think I'd base it on a percentage. I think I would, you and your team internally need to decide like, how many different people do we want competing for this deal as a lead, or just to be in this deal? And who are people who we would really love to have competing for this deal? And then once you have, kind of enough people who are in the running, who you think could be participating, and they look like the people you're interested in, you're pretty much ready to pull the trigger. And the only thing you have to ask yourself at that point is there somebody I'm really interested in participating in this round, but they're not quite at this stage yet? And then can I get them to this stage without like offending them or making them feel like I'm not being professional? How do I reach out to them to like let them know where we're at? And generally, if an investor is interested in you, they can move really, really fast, and they appreciate the heads up. So there's no drama with that. That's how I think we think about it.
But okay, I will say that sounds good. I think that it's rare, at least for me, in my experience. It's been rare to have like multiple people in due diligence where you're like, all right, now I'm running the show. You have to pretend like you're running the show, but you're not actually running the show necessarily, unless you've got like super hot deal that is just like, then I don't even think you need to be listening to this podcast. You're all good. I think this is for like the everyday entrepreneur like us, who, you have to have a vision. You have to believe in the vision. It's like, I will raise this money. You've got to stay like confident and put, whether you need to post an affirmation on your mirror or whatever you have to do, like you got to believe. You got to believe. I'm going to go to sleep every night saying we are going to close 20 million in financing at X valuation for this company. You've got to believe that and reinforce that in your own brain. What actually happens is what I feel like is really effective is doing what Rod said, is stating a date. Like, we're aiming to close by X date. You might not have anybody in due diligence at that point. You might have a bunch of people in the pipeline. You might have people dropping out, but you remaining confident on the outside and saying, we're targeting this date. We're heading towards this date. I think of that. It's very much what you're saying. It's just like, if you're not coming from this position of truly having 5 deals or X% of your pipeline is in due diligence,
you just have to believe in
you got to believe in yourself. You got to still set a date, and you got to say, hey, we're aiming for this date. I also would say the spreadsheet that Rod created has been really helpful in being able to talk to other connections. So we used that spreadsheet and shared it with a few people who are connected, who helped us with introductions. So the spreadsheet would have a blank in want to get to this fund, but don't have an intro. And unfortunately, the venture world still operates on needing an intro. And I don't know what that means for access to capital. I don't know what that means for like being able to provide equity among, you've got to kind of be somewhat connected to get in with a venture fund, which is feels to me privileged and wrong. Like there's something really wrong about that, but it is the game. And so, we
start earlier if you don't have a lot of those connections. You can get them, I would say. To the other thing you said about competition, I think that there's a huge fall off between like people who say that they're interested or take a second meeting, and then people who actually get into diligence. And once people are in diligence, that they are kind of really serious because they're investing real time, and you learn a lot from that diligence process. Now, what one person is doing in diligence versus what another person is doing in diligence, it can be completely different how serious they are. But that's a meaningful step when you can kind of start to see like, okay, who's really in competition.
And if you're doing that in diligence, so what you want to do is set up your data room. It's called a data room, and you want to have all your documents ready for diligence and look like the data room is open, so that the people who are coming in, your first person, let's say, who's coming in for diligence, thinks that there've already been people in the data room.
How do you make it look open? What's that mean?
Meaning like you have it set up. Meaning you have it set up and it's open and it's ready to go. You don't want to be like, oh, now I'm ready to put my documents together. Then that investor knows that they're the first one coming in, and they have leverage over you. So you want to kind of game it a little bit to,
You just always want to be more together than you think you want to be.
That makes sense. A little bit more in this, then we'll wrap it up. But what do you have a favorite data room vendor or software? And do you, in this whole process, do you ever tell other investors who you're talking to? This is one of these questions that come up. Do you ever signal to, XYZ that you're also in diligence with ABC?
So I'll take both of those really quick. So first off, I think like data room software, we actually ended up using like 2 different pieces of software for different things. We used DocSend for just sort of initial like PitchBook share and a couple of other like items. And then when we moved to a real data room, we were in a Citrix-based data room, and that was just because that's what our attorneys chose, because they helped run that data room for us. Don't really have an opinion about it. I think there are a few different systems out there. In terms of like hinting who else is looking at a deal or who else is putting pricing out there, to us, it didn't feel consistent with kind of how we present ourselves to like be naming names or anything like that. And we both had heard that it's never a good idea to try to like name drop. People can sort of like tell if you're busy or not, if you've got other people who are interested. But we never ever named anybody specific unless, there was somebody who was, maybe not interested in being a lead, but if there's a lead, they'd love to join in. And so like in that case, once we had, decided on who our lead was, we would let people know, because we wanted to be actively helping put that syndicate together instead of deferring to the lead. I don't know. What would you add to that?
Yeah.
Nothing. I think that was great. It's a numbers game. You gotta kiss the frogs. You gotta get to a lot of no's. It's a process. Invest in the process. Put one foot in front of the other.
Yeah.
Good. All right. Last question, or pretty much, what's the Boise scene like? Is there a lot of startups happening in Boise? Are there money in Boise? Is there venture capital in Boise, or you guys have to go to coasts to raise money?
So a good portion of our seed round was funded by Boise investors, either professional investors or entrepreneurs, and they continue to participate in subsequent rounds. And then we also raised money from, kind of network around the country. Boise scene,
yeah.
I don't know. I mean, it's growing pretty fast.
It's growing really fast.
Yeah.
I think that we just had dinner with our lenders and who are doing venture lending, and they're super psyched about Boise, and they want to come back and take a bunch of meetings with entrepreneurs, and we're their first deal in Boise, and they're really psyched. So I think, Boise's coming online.
Yeah. Inc. just listed Boise as one of the top 5 cities in the country to start a business. We got a little coverage in that. I think like one good indicator for us is hiring, because we're hiring in pretty much every single function. We're hiring software engineers, we're hiring marketers, we're hiring physical product people, we're hiring everywhere, and we're either finding amazing people in Boise, or we're finding people who live in places like Bay Area and Seattle who want to move to Boise because it's a great place to start a family, and to sort of like get established. And so talent has been pretty easy here, actually, getting really amazing talent. It's been great.
How long does it take to get to the closest ski area?
45 minutes.
Okay.
30 from my house.
Yeah, 30 minutes from your house, 45 minutes from mine. That's true.
That's good. Yeah. Great. Well, if you're hiring, if people want to learn more or apply for jobs, is the website loveverybaby.com or lovevery.com?
Lovevery.com. So it's LOVEVERY.com.
Awesome. Great. And they can find the jobs posted up there
on our careers page. Yeah.
Great. Any other last words of wisdom or calls to action you guys want to make?
Call to action. If you've got a baby in your life, if you've got a grandbaby, if you've got a friend with a baby, if you've got a new one coming on the way, you got to check us out.
Yeah.
It sounds cool. Yeah. Hopefully my kids got enough mental stimulation their first couple of years that they'll be okay. My wife's a tutor, and she's intense about getting them
I'm pretty sure they're all set.
They're pretty good. They're already surpassing me in a lot of areas. So awesome, guys. Well, thanks so much. This is awesome. We'll catch you after your C round 18 months from now and see what new lessons you have learned at that point.
Sounds great. All right. Thanks so much for having us.
Thanks, guys.
Okay.
Thanks.
Bye-bye.
Bye.